Welcome everybody to the 40 Finance channel. My name is Jeff and today I'm looking at the top ETFs for the first quarter of 2019. We're looking at which ETFs performed the best here in the first 3 months of the year. Let's jump in. So for this video I used the ETF evaluator over at ETF.com, which is shown here, and I simply sorted by year-to-date returns. And you see we have 5 ETFs that are leading the way. We'll get into the details of each one in just a second. But the most intriguing thing to call out here from all of the leaders across 2,500 ETFs that they track at ETF.com is that the ones listed here are all leveraged ETFs. They're all 3 times shares leveraged ETFs. And for me, this was actually a concept that I wasn't familiar with. And the ETFs that I own are more index related ETFs. So I had to do a little digging to see just what is a leveraged ETF. So here's a short definition from the Motley Fool. What is a leveraged ETF? Leveraged ETFs use debt and or derivatives to generate double or triple the daily performance of a certain index or asset class. Leveraged ETFs typically amplify daily returns by either 2 or 3 times and can be either long or short ETFs. So basically what you have here with a leveraged ETF concept, you take a category like say real estate or biomed and semiconductors, all of which we'll see here in a second, we're in the top 5. If you're very bullish on a sector like that and you have reasons why you think it's going to go up in the short term or even long term for that matter, investing through a leveraged ETF is actually one way to sort of triple down on a sector or asset class with the hopes of course, tripling, doubling or tripling your return. There are obvious risks to that approach. Obviously, if things go down in your sector or asset class and you're getting triple the fall, but on the other side, if you feel really good about a case for a certain category, then you can put all your eggs in one basket, so to speak, and look for much higher returns in the short and long term. Okay, so now looking at the top performers so far in 2019, number 1 on the board is the Direxion Daily S&P Biotech Bull, 3 times shares. The ticker symbol is LABU. And you see on Yahoo it has a year-to-date return of 71%. I think on ETF.com they had it as 66 and some change. I don't know, on ETF.com they might actually take out some of the expenses to give you like the net return, whereas on Yahoo it's just a straight year to date. I'm not sure about that, but both of them have this as the clear winner. And obviously a biotech bull ETF is going to contain biotech stocks. So the top holdings in this ETF are Spark Therapeutics, Mirati Therapeutics, Portola Pharmaceuticals, Sage Therapeutics, Acadia Pharmaceuticals, Bluebird Bio, and Clovis Oncology. So obviously the play here is that, you know, you're looking at drug makers, you're looking at cures for diseases, all these micro bets across the industry. And if you think it's going to be a big year for, let's say, patent releases or new types of gene therapy coming out, then this could be an ETF to triple down on. Looking at the chart over the past 5 years, this ETF reached its peak on July 2nd, 2018. It sort of dipped a little bit from there and then obviously went down as everything else did in December near the bottom of the market with the China trade fears. And it has since went up. So some of these gains that it's had, and you'll see this across everything, and you'll see it across stocks too, some of these gains in 2019 can look really, really good, but the fact of the matter is we were so far down heading into January 1st when the market crashed that these are ones that are just getting back to par, so to speak, quicker than normal. So stands right now at $57.92, and calling out here the expense ratio of 1.12%. The average or a good target that I've seen for ETF expenses is somewhere in the neighborhood of 0.5% to 0.7. There's obviously no cost index funds that you can look at that just take like the Vanguard total index, total stock market. Those are a lot cheaper, but anytime you get into a specialized managed ETF, you can pretty much expect the expenses to go up a little bit. And that's what I think we'll see with all 5 of the top performers here. So this one chimes in at 1.12% on the cost. Number 2 on the list is another Direxion product. It is the Homebuilders and Supplies Bull 3X shares with the ticker symbol NAIL, N-A-I-L. And I think that this is a pretty intriguing category to be in right now, because real estate, what really took it over the head at the end of the 4th quarter and into January over fears of a recession and housing information. You know, interest rates were going up, housing starts were going down, and generally speaking, the market was very bearish on the home building category. Whereas what we're seeing now in the very short term over the past, let's just say 3 weeks, interest rates have been going down slightly. The housing market is starting to warm up, both figuratively and literally. Heading into spring, obviously, is peak market for real estate. And with that, I think we can all expect sales to increase. But now that the interest rates for mortgages are actually going down a notch as well, this could be a breakout sector if all the chips fall into place. This ETF reached its recent high on November 1st, 2017. That was $92.32, and it's been very downhill from there. And it's only recently spun up to the $39 mark here in the past 3 weeks or so. For the top holdings that I really like, the holdings that they've set up here, you've got the obvious ones like Lennar Homes, Toll Brothers, etc. But they've mixed in some other things that I think are important to the home building market as a whole, and that is Sherwin-Williams, who obviously makes paint. Lowe's and Home Depot are in here too. So this really is tied very strongly to homes and home remodeling. So if you believe that all the bears on the market right now for the home space are wrong and things are going to rebound from here, at this price of $39 and knowing that it hit a peak in 2017 close to $92, this could be a nice little play for you if all goes well in the home building markets. Expense fee for this one comes in just under 1% at 0.99%, so a little bit cheaper than the Biotech one we saw earlier. Overall, I think it's an intriguing play. All right, number 3 on the list is yet another Direxion product, the Daily Semiconductor Bull 3x shares, ticker symbol SOXL. And this particular ETF is centered around semiconductors. So very interesting category to be in, since semiconductors can be so sort of cyclical. And when they fall like they did in November and December on weak computing demand, man, they really fall hard. But this particular ETF reached its high in January of 2018. That came in at $173. It's had the standard semiconductor roller coaster ride since then. It dropped down to 80 during the corrections that we saw in December, and now it's back up to 136. The semiconductors that it holds right now: Broadcom, Intel, Texas Instruments, NVIDIA, Qualcomm, and Analog Devices, just to name a few. So if you're bullish on semiconductors, which I don't have a deep knowledge of the semiconductor market, but I can tell you, coming out of December and January, I thought people like Intel and NVIDIA got hammered way too hard for technology that is almost certainly going to continue to grow over time. So this is another one where you could almost look at it as a beaten down sector a little bit, not as much as it was 2 months ago. If recession and trade fears spin back up and bring semiconductors back down, this could be a really interesting way, if you're bullish on, say, Nvidia, if they take another hit, to just jump in on this 3x leveraged ETF and potentially triple your returns for the same amount of money. All right, number 4 on our list is our friends at Direxion, yet again, with their daily technology bull, 3 times shares, ticker symbol TECL. This ETF focuses on consumer-centered technology, and I think that this is probably the closest one to my wheelhouse as far as something that I would be interested in and feel comfortable betting on, so to speak. The top holdings for this ETF are Microsoft, Apple, Visa, Intel, Cisco, MasterCard, Adobe, and Salesforce, just to name a couple there. And it reached its peak back in August 2018. So right before we hit the China trade fears and the falling market into December, it reached its peak. And for the year, it's up 57% already, but it has not yet returned to the levels to the highs that it saw in 2018. So right now you're at 136, 57% return on the year. And I think for some of these companies that are in here, this is probably one of the safer bets of something that would return to a good spot. Less chips need to fall into place, if you will, for consumer technology to get back to its highs. So when you incorporate Microsoft, Apple, Intel, Cisco, these are all things that just the normal economy, so to speak, they should see growing profits and potentially boost the price of it. You see on a simple 5-year graph that despite the ins and outs in the market, this one has grown really fast. It reminds me a lot of an ETF that I hold, which is the First Dow Jones Internet Trust. And some of these companies, as a matter of fact, are replicated in the FDN that I own. And so it might be worth buying a few shares of this TECL and just see what a leverage return can do for my portfolio. And rounding out the top 5, to have 5 of 5 on the leaderboard so far in 2019, Direxion again with their daily robotics, AI, and automation index bull, 3 times shares. UBOT is the ticker symbol. And the thing about UBOT that we have to be a little careful looking so far, the inception date of this ETF, it's not quite a year old yet. It came out on April 19th of 2018, very young. It premiered around the $20 level and has since went down with the market and then back up slightly to $11.49. For the year, it's returned 61%, which is great, but that's basically based off the dips that it had last December. And it's so new, in fact, that Yahoo only lists its top holdings as a couple of other ETFs. So it just lists the Global X Robotics ETF and the Global X Robotics and AI ETF. So I didn't find a lot of information on this one, and it's almost, too new to kind of recommend. But if you want to take an outside shot on this one, I think we all agree that artificial intelligence and robotics is a growing field, certainly over the next 5 to 10 years. So this will play into a lot of people's wheelhouse, and if you don't mind tripling your money on it or losing 3 times your money on it, then this might be one to try. So in closing here, I think this was a very interesting study for me to look at these leveraged ETFs. Obviously, they're using options and they're using leveraged money to make these buys. There's certainly a case in here where the ETF could be financially unstable at some point if things went totally wrong. I don't think the risk here is share prices going to zero necessarily. I think the real risk here is just extreme fluctuation, some of which could be down, and that can really wreck your portfolio in a given 1, 2, 3 year time span if one of these sectors simply collapsed. and that's what you have to be careful of. So, but you know what, from a short-term perspective, if you see something in 2019, whether it's biotech, housing, consumer technology, if you really believe that there's going to be a strong bounce back in any of those sectors, then one of these leveraged ETFs might be an interesting play to make without having to pick individual stocks. Guys, hope you enjoyed this video. Please like if you did and subscribe to the channel. I look forward to seeing you on the next one.